All right, guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we've got Larry Pesavento here for a very special webinar as part of our 4-year anniversary. All month long, we have very special events. We actually have 16 events in the month of June. I believe this is number 9, so we're almost there. In all of those events, we're giving away some very special prizes, including this webinar. Some of the bullet points that Larry wants to talk about today include the key to pattern recognition, how markets are mathematically similar, how to define trend correctly, the 4 best patterns to trade, controlling risk, how and why, and learning to think in probabilities. Pay close attention to the content that Larry discusses today, because at the end of the webinar, we are going to be giving away 10 prizes. 5 of those prizes are autographed copies of Larry's book, Trade What You See, and there's 5 other prizes that Larry will go into himself. It's for his products and services. The answers to those prize questions are based on the content that Larry covers today. That's why you're going to want to pay close attention. The webinar is being recorded as always. I'll post the recording sometime tomorrow on YouTube. If you're watching the recording, do me a favor and give us a thumbs up if you like it. Also, if you will please hold your questions until the end of the presentation. Larry has asked to just hold them until he's done, and then we'll open it up for Q&A at that point. All right, guys, give me 1 second, and I'm going to turn things over to Larry. Okay, Larry, you should have the option to share your screen.
Okay, so I hit show my screen then?
Yeah.
All righty.
Okay, we've got it. Thanks, Larry.
Okay. Do I go ahead and start?
You're ready to go.
All right, good. Well, thanks for joining me this afternoon, folks. I should tell you a little bit about myself. I started trading when I was a freshman in college at Indiana in 1959. I have a Bachelor of Science in Pharmacy, and I have a Master's in Business. And I traded, after I got out of pharmacy school, I went to work for Eli Lilly for 10 years until 1974. But after 74, I traded by myself until 76. And then 1976, I took over the commodity department of Drexel Burnham Lambert in Beverly Hills in the Mike Milken building, and I was there from 1976 to 1981. 1981, I went to the floor of the Merck, and I got a seat at the CME, and I traded there from 1981 to 1984. 1984, 85, 86, I worked for Commodity Corporation in Princeton, New Jersey on Mount Lucas Road, and in 1986, the end of 86, start of 87, I went out on my own, and I've been on my own ever since. All of my time has been, I've just loved this business so much. I mean, I'm always on vacation because I'm doing something that I really love. And what I'm going to share with you today is what I think is some of the best stuff that I learned over the years. And I've got a library of over 3,000 books. That was at the last count, and things that I've studied through the years, and I'll try to show you what I think are the better things, to look at. I'm going to start the program today with a picture of Pythagoras. This was done by a man named Augustus Knapp. This painting is a very large oil painting that's in the Philosophical Institute in Los Angeles. It's up on the top of Mulholland Drive, about a mile from where Mike Milken lives. Near the Getty Museum, and it's a beautiful museum, and it's got all kinds of wonderful things in it. It was started by Manly Hall, who was really very instrumental in bringing so many things about the metaphysics of life and, the different types of religions and where they came from, and the, anywhere from the Knights Templar all the way through the Masons and stuff like that. It just got all kinds of things. Going all back as far as you can go. But this picture by Augustus Knapp depicts what Pythagoras was supposedly what he looked like. And it comes from a variety of sketches. In other words, this is a compilation of different sketches that Knapp put together to try to describe what Pythagoras was talking about. Now, Pythagoras was born in 600 BC. He's the father of modern geometry. Albert Einstein said that there was God and there was man, and in between was Pythagoras. Einstein said without doubt he was the smartest man that ever walked the face of the earth. And what you're looking at here is a picture of a globe on the left-hand side. You can see it there. And that is a picture of the earth being round. Remember, he was in 600 BC. He wrote a paper when he was about the age 50 that he determined that the earth was round, and he knew that the distance between the earth was 250,000 miles. He derived that by using the theorem that's famous for himself now, the Pythagorean Theorem, which you can see on the lower parchment there where the checkerboard squares are showing the triangle. Now, the reason why I'm bringing this together is because, as you can see with his left hand, he's pointing to that same theorem on a little circle. He has a proportional divider laying on the table. There's another proportional divider over on the left on the ground, and you can see the seraph tree that's there, and then also the music, because he believed that music was very instrumental to mathematics. He's holding a pyramid in his left hand, and above all, on the top of it, is a pyramid that has the 10 spots in it. That's known as the Sierpinski Triangle, and that has to do with chaos game theory. Now, this was from a variety of sketches that they put together, and all I'm doing is to try to share with you some of the little simple things that you can use in the markets to try to define, what to do, when to do it, and try to, make some money off of this. And that's the bottom line. What most of you folks are here for is to try to see. So I'm going to proceed on some of the things that we're going to be looking at here. I'm a true technician. I do not look at anything fundamental. I don't listen to the news. I react to what the news is doing, but I believe that the sum total of all the buying and selling is on that bar chart. If they're buying, prices are going up. If they're selling, prices are going down. That's the only thing that I need to know, nothing more. And believe me, I've been doing that for years, and it's so far it's been okay. Now, we have a situation here that I hope everybody can see this. This is a geometric characteristics of a price chart, because when you're looking at a price chart as a technician, you're looking at a square, and within the square are the two triangles that have the hypotenuses that are related to the Fibonacci sequences. Then you have an isosceles triangle. You also have a circle, and then you have a triangle, a circle, and a square all together. And what you're trying to do is to get to the lower right-hand diagram, and that's where we're trying to intersect price and time together to determine if a pattern has completed and what is the probability of this pattern working, and if so, how much is it going to cost us to find out, what it's going to take for us to enter the trade and what our risk is. I'm basically risk averse. Risk is the only thing that you can, control of the risk-reward equation. We never know how much we're going to make on a trade, ever. We never know which trades are going to work, ever. So the only thing that you can control is the amount of money that you want to risk. Remember that, winners think how much money they can lose. Losers think how much money they can win. That's why Las Vegas has all of these beautiful signs and pictures of, people winning, 4 sevens or, the World Series of Poker or whatever it happens to be, where you can make millions of dollars, but they never tell you that, we build these casinos on your losses. And that's the main thing that you have to remember, because you can lose a lot of money in the commodity markets or stock markets or foreign currency. But remember, there's no relationship between speculation and gambling at all, other than the fact that we keep score with money. Speculation is based on something that you determine when you want to play, how you want to play it, and you determine the rules. With gambling, it's determined by an event that's determined by the flip of a coin, blow of a whistle, roll of the dice, spin of the wheel, toss of the ball, whatever it is. Once that game starts, it cannot be changed until the game is completed. The bet cannot be varied, and that's the main thing. But what we do is we just determine when we want to play, how much we want to bet, and we can change our bet in the middle of the game very easily. We could add the positions, we can take the positions off, and we pay a very small commission for that. So there's a very small relationship, very small, only to relation with money between speculation and gambling. I hear this argument all the time, and I try to tell the really truth behind it, because there's very little between the two. Okay, the next chart we're going to look at here is a chart that comes from a very rare book called the Thrust Method of. It was actually from William Garrett. It's the name. Oh my gosh, I have this book on my desk, and I can't. I'll think of it. It's not the Thrust Method. Oh dear, what is it? Well, it's by William Garrett. When we come to the thing, I'll remember the. I'll remember it as we go through. I'll certainly remember, because I met Mrs. Garrett before, and the book is very, very important. But on page 89, which happens to be a Fibonacci number, William Garrett described the same type of thing that we were looking at with that chart, but he did it with squares, circles, and ellipses, because what you're doing is you're looking at a square, and the square expands to a circle, and the circle expands to an ellipse, and that's exactly what's happening in our solar system at all times. As the planets move around, they're moving around these exact same types of ratios that we have when we're looking at the charts. And when you see the Fibonacci numbers there, you'll see that they expand by 618, 1.618, 2.618, and pi. That's how they expand out. Now, you don't need to know all of this, because it's going to be a lot more simple than this. This is just where the theory arrives, and why it is mathematically important to realize that this is something that is very, very predictable. That's the main thing. Now, hopefully, we're going to be able, at the end of this time, well, it won't be at the end of this, because there'll be a few of you that will follow through and try to learn some of this. But this will be the type of chart. This happens to be a chart of Amazon on a daily basis, and it has all of the patterns that are here. You can see the 1-3-5 pattern that is there, which is a 3 drive to a top pattern, and there's other patterns that here, but we're going to go through them and show you. But this is a compilation of what a chart will do after you understand what pattern recognition is, and you can determine these spots, and the places where you want to be a buyer or seller. And believe me, you can learn this. This is not rocket science. All you have to be able to do, and I will demonstrate this in just a few minutes, that you are able to do this if you can draw a straight, well, you don't have to draw a straight line. You could draw a crooked line, it'd still work. But if you can add, subtract, multiply, and divide, you will be able to do this. Now, some people can't trade just because of the fact that there's something in their background that prevents them, something that either their parents have left for them, some real negative things, or a spouse, or, it could be anybody, but that's the things that you have to overcome. And trading is really, 85% mental. What I do here is the 15% that, gives me a window into what I want to do, but you also have to have the courage and the discipline to, to follow your plan and to do the right thing at the right time and believe in it impeccably. You literally cannot, say, I'm going to do it one time and then not do it another time, because we're only dealing in probabilities here. There are no certainties ever in these markets. There are only probabilities. Even the best of patterns only work, the best ones work about 85 to 90% of the time, but you don't see those very often. And even those lose, 15 to 10 or 20% of the time. So that's what you have to realize, that you're always dealing in probabilities and trading in probabilities, and better yet, thinking in probabilities. It's not what you think, it's how you think. And that's the important thing when you're trading, is to try to learn, the difference in trading. Now, I wanted to show this because this was something that we live in Hong Kong part of the time, usually 1 month a year, and we have many friends there. And I was interviewed by the Wall Street Journal in Hong Kong in October of 2010, and I had made a prediction that the Hang Seng Index was making a major top, and this was the pattern that they put into the newspaper, and the article was about the fact that I had made this prediction that the Hang Seng was going to top, in October of that year, and in fact it did, and it did go down quite a bit. And so these are things that sometimes they work, sometimes they don't. This one had a lot of other factors that were in here. As a matter of fact, that 1.27 number that you were looking at there at 24,233 was a 61% retracement coming off the all-time high from 2007. So this was really a major spot. And of course, the market went from 24,000. It topped actually 3 days later when it made the number, and the high was 24,450, I believe. And then it went down to below 16,000, and right now it's around 20,000. So it's come back a little bit, but that's the the bottom line of what we're looking at. I'm just showing that you can make predictions like this too. I mean, this is not it's not hard to do once you understand it. Now, the reason why this stuff works is that the market can only do three things, folks. That's the bottom line. This is why pattern recognition is important. It can go up, it can go down, and it can go sideways. That's basically all it can do. So as a pattern recognition swing trader, what you're trying to do is determine whether it goes up, down, or sideways. That's what your job is. And when it gets there, you say, okay, what is my risk to see if this is a place where the market is ready to be a buy or a sell? That's really what you want to do. Now, this pattern that you're looking at, this ABCD pattern, was done originally by a man named H.M. Gartley. The name of the book was Profits in the Stock Market by Gartley. It was written in 1937, and the book at that time cost $1,500. It was in a loose leaf binder, 3-ring binder. It was 700 pages, and the cost of the book, as being $1,500, was the cost of 3 Ford automobiles because we were in the midst of the Depression. He only sold about 80 copies of the book, from what we can gather, and I ran into the book in 1970 from a friend of mine in Santa Monica, California, named Don Mack. He ran the Investment Center bookstore, and I was trading in the McCulloch Oil business, in McCulloch Oil building in on Wilshire Boulevard by UCLA, and this is the office where about 5 market wizards traded out of. There was Mike Marcus, Ed Secota, Jeff Silverman, Jay Cross, Rick Barnes, and several others, but they all traded there during the early 60s to mid-70s, and that was the office where I did a lot of my trading. But this ABCD pattern was on page 249 of that book. Well, between pages 200 and 249 were all of the technical patterns that Gartley used. This basically covers the whole gamut of the technical analysis of the commodities that I can see in Forex and stocks. I primarily trade foreign exchange and futures. That's 99%. Well, I do. 99% of what I do is Forex and futures. And I work with a hedge fund that I run with 2 of my other colleagues that were students of mine a few years ago. We've been doing this for the past 5 years, and that's what I do. And I trade every day, and I try to be right, 3 days a week. I'm usually wrong about 1 day a week, and I break even about 1 day a week. We haven't had many losing weeks. We've had a losing month here and there, but not many losing weeks. But we do have losing days, of course, in between this, because those are things that we have no control over, and we don't expect to, because that's the bottom line of what we're looking at. Now, the main thing about these patterns is that well, let's just go on to the next one here, because I wanted to show you folks about learning these patterns. I know that the Fibonacci numbers, years ago, this was very, very, esoteric, and the Fibonacci was known as the F word. Nobody talked about it, and very few people understood it, and still a lot of people don't understand it. But I try to keep it as simple as possible, because I think that if you break it down into its simplicity, that's the best, because we're only looking at a price and time axis, and we're trying to determine whether a market is either expanding or contracting. And these are the numbers that I look at. 618 and 786 are contracting numbers. 1 is the AB equals CD move, where you have the AB leg equal to the CD leg. That's also known as the Thunderbolt Pattern. That pattern on page 249, the ABCD pattern, was on Gartley's book. That was sold as a trading system in the 1950s by a man named Frank Tubbs. And then it was sold again by Larry Williams and Charles Lindsay as the Trident method in 1974, I believe. And I happen to be a neighbor of Charles Lindsay in California, but I was a very good friend of Larry Williams, which I still am to this day. And so I learned quite a bit from what they were doing, but they got it right out of the Gartley book, and that's where I got it. And I wrote my first article about Gartley, the Gartley pattern, I believe, in 1975 for Old Futures magazine, which has since now become Stocks and Commodities. But that's when I first did it. And I published my first book, which was Astro Cycles, The Trader's Viewpoint. I brought out the Gartley pattern in 1987. Now I can't tell you how many places on the web you can find Gartley. Some people do it wrong, some people do it right, but it's helped a whole lot of people, and it's spawned a whole new industry, and it's helped a great deal of people too, because if you follow that, it can lead you, to the promised land. There are other patterns too, but by far, I think that the Gartley pattern is the best. Now, you can do all this by looking at a calculator, and with a straight edge, a ruler and a pencil, you can do all of this. You don't have to use a computer, but computers are easy. When I first started trading for the first 5 years, and it was more than that, it was up until 1976 when I got to, we used Bunko Ramo machines at Conti Commodities, but when I traded at home, I had a ticker tape from the Merck and the Board of Trade, where it would literally, go into a paper basket, and that's how I traded. But then in 1982, the computers came along, and now you guys are just like floor traders. You have all the advantages and none of the disadvantages, so it's a lot easier. Now I'm going to try to show you the theory behind why things work, and this is where I think the bulk of what we're looking at will try to help. But this is a 30-minute chart of the euro versus the U.S. dollar. And if you look at this, and it's over a 10-day period, you look at this and, my God, how do you find out any harmony in this? I mean, there's nothing there that looks anything close to being, some type of a relationship. All you can tell is that you've got lower tops, so that means you're in a downtrend. You've got lower bottoms, that confirms that you're in a downtrend. And then towards the end of the chart on the right, you can see that you've got a higher bottom coming in, and there's a possibility of the market, getting ready to go higher. So your definition of a trend, no matter what you're doing, if anybody tells you, they know what the trend is, you have to ask them the question is, what's the time frame that you're looking at? Because it's the time frame that determines the trend. If you have higher bottoms and higher tops, you're in an uptrend. If you have lower bottoms and lower tops, you're in a downtrend. So if we're looking at this euro at this particular time, and we don't see anything here, all I'm going to do now is to overlay these triangles that we're looking at with the ratios that we just talked about, 618, 786, 1.27, and 1.618. And 786 is the square root of 1.27, and 1.27 is the square root of 1.618. So all those fit together. There are other things that are there, but if you'll notice, you can see some of the A, B, C, D patterns that are present, on the chart. I don't mark them all because it would be, too cluttered, and I just want to walk you through, some of the things that we're looking at. So this shows you that the market, even though, and this is the most actively traded thing in the world by far, folks, nothing even comes close to the U.S. dollar versus euro. I mean, it's the big one. It used to be up until 2000, the euro came on in 99. It was the pound versus the dollar up until 2001, and then the euro took over, and it has held the lead ever since. And we'll go to the next chart here. And this is a 1-minute chart of the euro versus the Forex. And all I'm going to do here, we talked about this ABCD pattern, and I wanted to show you, there's a lot of small ones on here, but really what I wanted to do was to just show you a 1-minute chart, and you'll see that there are 3 major ABCD patterns that are there that are just about as mathematically perfect as you can possibly get. Now, you might ask yourself, well, you selected one that is works this way. Folks, this works like this all the time. That's where pattern recognition comes in, is because it is repeats over and over, and it is predictable within limits. So what we're trying to do is we're trying to predict what point C is going to be, and also what point D is going to be, because those are the areas where we have the best probability of trade and where we can control our risk the easiest. So we're looking at a 1-minute chart, and the next one we're going to look at is the 30-minute chart, and you can see they look almost the same. It's just that the time frame is different. I didn't want to put the patterns in here because you can see them easily once you start to look at the chart that they look like thunderbolts. That's basically, what you're looking at. So that's the process of what we're dealing with here. Now, this is we're going to show you this pattern in real time now for a couple of these, and we're going to go on to something different. But this is the ABCD patterns for Apple, and believe me, Apple has been one of the most beautiful technical charts you could ever run into. When Apple was trading at 565, well, actually when it was trading at 700, it was screaming, sell me, sell me, sell me, and then it left an island reversal up there, which was the major thing. But when it got to 565, that was when it telegraphed that it was going to below 390, and the low was 385, and we had a very distinct pattern. And you can see this ABCD pattern on the right. It looks like a thunderbolt. This happens to be the bearish ABCD pattern. That's the one that we're looking at right now. And now we're going to take a look at the U.S. dollar index, and this is another ABCD pattern, but this one is a bullish thunderbolt. And you can see the ABCD pattern moves higher. Now, I don't put the ratios in, but because the ratios are very important, we have to cover those. But what we're going to do is we're going to, pick an example here of something that has happened in the past, and we're going to look at it, and I'll show you that you can do, do some of these things yourself if you'll practice and learn, because the market will really tell you what it wants to do if you look at it. There's not a mystery to it at all. And I'm not a believer that the Federal Reserve, controls everything, because that's not the case, because if they did, they're controlling it in perfect mathematical unison and most of the time, and I'm talking 90% of the time, then I would do it. Now, there's craziness around Fed time, but that's because of us. We're the ones that get in there and make the, the craziness happen. I don't trade during, Fed announcement or major economic reports. I wait until the reports are out, and then I want to see, what the market's really going to do. So there's no control in the markets. They're too big, as a matter of fact. They can be controlled for a short period of time, but not over a long period of time by any stretch of the imagination, in my opinion anyway. So we're going to move to the next chart here. Okay, this next series of charts, there's about 8 of them here. Now, folks, I'm talking to the people out there that are having major trouble. They don't know what they're doing. They're losing money all the time, or at least regularly, or breaking even. Ideally, if you're breaking even, you're going to be okay. If you're losing money, stop trading real money until you understand what the heck you're doing. If you're breaking even, keep going. You're just one turn screw away from big money, because once you understand how to make that last little adjustment in your trading, then you can be successful. And being successful in this business is serious money. It's not just a few thousand here, a few thousand there. You can make a good deal of money, take care of your family, live a very nice life, have a lot of freedom, and work when you want to. I work about 3 hours a day on the trading. The other stuff is just administrative work and things that I do. But it's really fun. I get up early. I'm up by 5 in the morning, which is 8 o'clock Eastern time, and usually in the afternoon I'm finished, and I'll do a little bit in the evening before I retire. But and I do this all the time, even when I'm on vacation. The markets are always on my mind because it's fun. I enjoy it. It's my profession that happens to be my vacation. Pythagoras, it wasn't Pythagoras, it was Confucius, said that the man who does what he loves is always on vacation, and that's the truth. I have no question. This is General Electric, and if you look at this chart, well, all I'm saying is if you want to learn to do this, the first thing you'd want to do is to find highs and lows on the chart. Just pick a high and a low. Pick the major ones. Don't pick all the little ones that are in there. Just pick the highs and lows. That's really what you want to do. And I've done the first 4 swings for you on the chart. And what we're going to do is we're going to walk through this. Now, I'm going to tell you something now that you probably you'll find hard to believe, but it is the god-awful truth. And that is that if I would have had these 10 next slides from this one through the next 7 or 8 or 9 that are coming here, knowing what I know now, knowing what I knew back in 1974, I would have paid probably somewhere around $250,000 to learn that information. Because this is the information that is better than any education you can get at Harvard or Princeton or MIT or Oxford or any of these places or any law school or medical school, because this allows you, to work for yourself and to, do what you want to do, not rely on employees working for you or things like that. But these are the things that will teach you how to get to the promised land. It doesn't work all the time, but nothing else does either. But it does give an indication of where things are going, because you'll have an idea of how these patterns, start to work, because you'll be able, after you learn them, of course, if you have an interest, and those of you that don't, I just hope you find this entertaining. But this is what we want to try to do, is walk through this General Electric, and then we're going to do a couple others just to show you that it works in other things too. And then at the very end, I'll answer some questions. But we'll go through and we'll see that the market has made the first swing down, and then it takes out the high, comes down and takes out the low, then it goes up and takes out the high. And then what we'll do is we'll just complete the rest of the patterns. All I did was connect the highs and lows. And every single ratio on this chart here is related to those 4 ratios that we talked about. 618 and 786 are contracting numbers where the market's pulling down, and 1.27 and 1.618 are expanding ratios where the market is expanding into new highs or expanding into new lows. That's all you're looking at. And if you look at the Thunderbolt pattern, when you're watching this, you can see very easily that there are several Thunderbolt patterns. There are 2 right in the middle from March through May is one big ABCD, and then there's another one between May and June. And they're all related to these numbers that we just talked about. And believe me, I looked at Elliott Wave back in the 1970s. John Hill, who was one of my mentors. I had 2 mentors. Well, I actually had 3 mentors in my life. I had John Hill, and I also had Dr. Ruth Miller, who helped me with the astroharmonics of the market. She's 93 years old. She can't hear very well, but she trades every day. She can't drive a car, but she says, as long as I can trade, she says, I'm happy, and that's all I need to know. She just turned 93 last Wednesday on June the 12th. John Hill, who's 88, runs Futures Truth, and his 3 kids are all in the business. 2 of them run hedge funds, and then Lindsay runs his own trading operation where he just trades for himself, as what John does. John just trades for himself, and then John runs Futures Truth. But they're still trading actively, well into their late 80s and 90s. And I've got a lot of other friends that are doing the same thing, but I'm not very far away from that age anyway. Okay, we're just going to look at the British pound now. We're going to walk you through these patterns, because if you look at this chart, I know, I did the same thing. When I first looked at a chart like this, I said, how in the heck can anybody make out any sense of what's going on? Now, 1 hour and X number of minutes webinar, you're not going to get this, folks. All I'm trying to do here is talk to the 3 people out there. There's 3 of you. I don't know which 3 you are, but there are 3 people out there that really want to learn this, but they don't know what they're going to do. But these are the people that I'm trying to hit. Most of you, you just have no interest in it at all. You're being pleasant by staying and listening to me, because this might be something different than you've seen before. But most people will not look at this because it takes a little bit of work and it takes some understanding of how these patterns work. But it's really nothing more than triangles. It's really all you're looking at. You're trying to find a high, you're trying to find a low, and what do you do in between? So basically you have the British pound versus the U.S. dollar. It's a Forex pair that I trade quite a bit, and it shows that from the high to the low, you've come back and made a 786 retracement, which is one of the retracement numbers of the Fibonacci summation, series. And so that's the square root of 0.618, by the way. So what we're going to do now is we first found the step 1, which is the 786 retracement. So step 2, what we're going to do is we're going to find the AB equals CD pattern. And if you go down to the bottom, you can see the AB leg, and then you see the C leg, and the BC leg, and then you see the D leg. Well, the BC leg pulls down to a smaller ratio than we usually use. This one comes to a 382, but it does form a perfect, ABCD at the 786, which makes this a perfect Gartley pattern. Now I'm going to spend just a minute here on Elliott Wave, because the things that we're doing here have not any relation with Elliott Wave other than that we use 618 and 1.618. Elliott did not use 786 and 1.27. He didn't know what they were. And it wasn't until 1996 that Prechter began to use 786 and 1.27. But you need to know that from the very beginning, because people that do Elliott Wave, and many of them are very smart, but the problem is if you get 3 Elliott Wave people in the room, you're going to get 9 different answers, because all 3 of them have 2 alternate wave counts. And what we do, there's no alternate wave counts. It either works or it doesn't. You don't have to worry whether it's a 2 or 3 or 4 or 5. It's not important by the way we trade. And so this is what we're looking at when we're doing these, is to try to find ones that are easy and line up very nice mathematically. And that's what I'm trying to do, is to show you some of these patterns that we're looking at. Now when we add the last swing that occurred, step 3 is to find the second ABCD. You'll see that you'll have the same type of a relationship there, where the smaller ABCDs in the gold are exactly like the ones that were in the white, except they're on a smaller time frame. So what you're doing is you're measuring on the right-hand side, which is the price scale. You're measuring the price scale, looking at this Thunderbolt pattern, telling you, that's where you are, at that particular point, and that makes, the British pound a good sell up in this area. And as luck would have it, it did start to, to move down. So what we're doing is we're just showing you, the harmony of what's happening with the price. Now the second step, because we're looking at a price chart, we have to look at the time factor too. Now time is more elusive. Albert Einstein said, time exists, so everything does not happen at once. Is very true, and time is very, very hard to determine a lot of times in the markets, and it's always a probability. There's no, like I've said many times, and I repeat it over and over again every chance I get, there is no perfection in these markets. There is only probabilities and risk control and responsibility. You have to take the responsibility for your trading, no one else, and that's why you don't ever want to have to rely on anyone where your next trade is coming from. If you do that, folks, go get a job someplace else, because if anything happens to that person, you're left out in the cold and you'll be more frustrated than ever. And so don't do that. The students that I've trained over the years, they all do this themselves now. That's where a lot of these websites come in, people that are teaching Gartleys and butterflies and ABCDs and stuff. But you got to learn to do it yourself. You have to take the responsibility of doing it. And once you can do that, then you have your chance of making a living at this. Now we're going to look at the time scale now, and all we're doing now is we went and looked to see the time up in the move was equal in both of those moves. In other words, from the A to B was equal to the C to D leg in time on the last leg from C to D. You can see that was a perfect Gartley coming in at that particular time. And a Gartley pattern is nothing more than an ABCD pattern coming in from a higher level, which would be way back there in August. In other words, Gartley spent in his book on page 221 and 222, he spent 2 full pages describing this particular pattern. No place in his book did he spend 2 pages describing a pattern. So when I looked at it in 1970, I said, well, this must be pretty important, because if this book cost this much, and Don Mack, who ran the library there, who owned it, he told me, I asked him what's the best book to learn something, and he gave me that Gartley book and said, sit down and read this. And we became very good friends over the years, and that was the book that was a big change in my life. Later on, I found the Fibonacci numbers through John Hill, and then later on Bryce Gilmore. But I had the bulk of it, but I didn't have the last few pieces until mid-80s, around 1986, 1987, when I finally put it all together in a pattern that was descriptive of what I was trying to show. Now what we're going to do is I'm going to blow this up and show this symmetry a little better, because then you can see the time up in the move between March and April is equal to the time up between April and May. There's an exact number of days. As you can see, the slope of the line is very clear. And if the move measures in price to ABCD, why wouldn't it measure in time in ABCD? So that's where you have time and price coming together. This was one of the things that W.D. Gann tried to describe when he was doing price and time, and he used the square of 9 and a few other things that were very esoteric, and most people, including myself, have a very hard time understanding, whereas this is much easier, and you don't have to make any calculations on things that are really very difficult. This is the total package of everything that we looked at right here. And now what I want to do is I want to show the same thing with a euro in a 5-minute chart, looking at, and this, believe me, this is really active. And as you can see there, on the June 28th, there was a report that came out. That's what causes these fantastic moves that we get. A report comes out, and after the report, you'll see that the market made a really nice ABCD correction. Then it proceeded to go up to another new high, and then made another ABCD correction where D ended right down near where the 1.618 level was, and that's when it started another move to the upside. So this is what I'm trying to do, is to show you. You can do it on the daily, you can move down to the 5-minute, you can do a 30-minute, you can do an hourly. But once you decide on what you're doing, stick with that time frame, because that's the chart that you're looking at. You don't want to mix and match time frames, because it's going to look different on a 5-minute chart than it does on the hourly chart. And the hourly chart, if that's the one you like, that determines what your risk is, because you want to enter at point D or at point C and determine what your risk is at that point. Well, if you can put the odds in your favor that you're going to be right about 65 out of 100 trades, and of those 100 trades you're going to lose on about 20, and then you're going to break even on about 15, because they'll start at a profit and you can lower your stop to break even or raise your stop to break even, either one. Now you have a situation where you have a tremendous probabilities in your favor. It's like playing blackjack in Las Vegas, where you have an ace in your hand every time, because the probability of you winning is better than 65%. Vegas is not going to give you those odds, I can tell you that. And if you have an ace up, that means you have a chance of getting blackjack, and they're certainly not going to play with that. Now let's assume that the dealer has a ace up also, so now your edge has completely dissipated. You don't know what the second card is yet, so you both have an ace. But if he pulls up a 6 or a 5, you have a tremendous advantage. Now if you turn over a 3, your advantage has changed. Well, in our business, if you turn over a 3 and you don't like the pattern because it's not moving in your favor, you take your money and run. You take your bet off the table. You don't get to do that in Las Vegas. That was the analogy that I was giving to you earlier about speculation. You get to determine the rules. You get to determine when you want to play. You get to jump in the river. They're not going to throw you in the river like they do in Las Vegas. So that's the real difference between gambling and speculation. That's what you're trying to do. Okay, we'll take a look at the next one here. This is a further example. You see the market went up and made a 786 retracement, and then it started down to make another move down. I was just showing you, how these markets move all the time, and they're doing this all day long, every day. It's the same thing. I don't trade 5-minute charts, but I wanted to give you some ideas that if you like short-term trading, that's pretty much what you look at. I usually look at 30-minute and 60-minute and the dailies. Those are the ones. But occasionally, when the market's really active and really moving, then I will go down to a smaller time frame. Nothing smaller than 5 minutes, however, because the rest of it to me is just flutter. I'm not interested. And I'm trying to be patient to wait for the patterns that unfold, like the Thunderbolt and the others that we're going to look at here. Now, this is the same thing that we had in crude oil here, the same type of pattern. We had a big move in crude oil where it moved, a great deal in a matter of a very short period of time. And, what we're trying to do is to find that first ABCD correction and, try to buy that. Gardley said in his book, the safest trades are to buy the ABCD correction after a new bull market starts, or to sell an ABCD correction after a bull market or after a bear market has started. In other words, you don't have to pick the bottom down here where you have a 1.618 expansion down at 77.40. You could wait and be safer to buy it at this level, because if you buy here, your risk is very controlled, because if it goes down much below 1.618, that's the last ratio that we have. So you don't want to be involved in trades that are that way. So I'm going a little fast, but I think you'll be able to understand it. Now this is the euro on a weekly basis, showing you the same thing. Before we looked at the British pound versus the dollar on the weekly, on the daily. Now we're looking at the euro on the weekly. And this is where we are right now, folks, in the euro at 134. This has completed all of these patterns in here, and we're right at this 707 number. We're completing the ABCD pattern and everything. So when you get a chance, if you'll take a look at the euro right where we are now, you want to be looking to sell that in that 134 area, and that's that's the bottom line of what we're looking at. I'm sorry, someone just Skyped me and asked me a question if I knew someone from years ago, and the answer to that was yes, but I haven't heard that guy's name for years. His name was Richard Ney. He was an actor who was on FNN in California many years ago, and it was before we had hedge funds, and he was an investor, and he was a very colorful character. I met him several times, and I was on a few panels with him speaking. But anyway, this is what we're looking at. This was the first Gartley that occurred, and then the market dropped well over $5,000, and then it went up and made the next Gartley, and then dropped another $7,000. And again, you can see the yellow ones are the Gartleys that are in here, and then I put in the darker green one for the other ones that you look at. You can do this, folks. This is not Picasso or Da Vinci or anything like this. This is flat out A, B, C, D. Give me a pencil, give me a calculator, and this I can do. So just remember that it's not that hard. I didn't even put in some of the very large ABCs that were in there, because at point A down there, that was actually the point D of the larger ABCD that started back in 2008. So weekly charts, you take a lot more risk. That's why you've got to go down to a daily chart to keep your risk from being, from being too much. Now this is the banking index, basically showing. I'm just showing you different indexes here and different instruments because they all work. All I'm trying to do is to give you an idea that these things fit together, much like a little glove. That's really what we're watching. This is crude oil, and what we're looking at now is a 3 drive to a top pattern. We have drive 1, drive 2, and drive 3. We had the same thing here, drive 1, drive 2, and drive 3. This one is more interesting because you have that reverse point wave, and you also have the time distance between the first high, the second high, and the third time that is equal. And each time it makes a new high, it is telling you that it is going up into resistance. That's what you're doing. This is a reverse point wave pattern that we're seeing in our stock markets now in the U.S. and in Europe. This is the long-term weekly charts that we're seeing with the Dow up here at 15,300. This is the pattern that we're looking at. We're looking at the mother of all tops, in my opinion, in the stock market as we are approaching, July 4th. That's what it looks like, in my opinion. So that's what we're watching. Anyway, this is a 3-drive pattern. It's in Gartley's book. In 1960, a man named William Dunnigan came out with a book called the Dunnigan One-Way Method, and that was a thrust formula. And he had the I just remember the name of that book by William Garrett. It was Torque Analysis of Stock Market Cycles. It came out in 1970, the same time that William Hurst came out with a book called Profit Magic of Stock Transaction Timing. They were both engineers. One lived in Hawaii, the other lived in California. Both books were published by McGraw-Hill, but one, Hurst book, the Torque Analysis, was $29. And the cycle book for Hurst, the Profit Magic, was only $8. And back in 1970, that was a lot of money. So very few people bought the Hurst book because it was much more difficult to understand. But it was the true meaning of cycles. And it's basically, you can still find it. It's a rare book, but it's a great book to have if you believe in cycles, because it explains cycle theory really quite well. Okay, we're going to go to the next one. This is showing Goldman Sachs. I'm going to give you some ideas of this. Is that same 1, 2, 3, 4, 5. It was called the 5-point reverse wave pattern. Gartley listed his triangles as T1 through T12, I believe. This was the T6 pattern. This pattern was taken by Wells Wilder in the early 90s, and he sold it as a trading system for $2,500, word for word, right out of Gartley's book. More trading systems came out of Gartley's book than all the other books that I know of combined. I mean, there's been, I don't know how many, there's just been a lot of them. But this is one of them, and it is it's a tremendous move that we're looking at here. The fact that each wave must exceed the previous wave, and it goes up and makes that 3 drive to a top pattern at a 1.27 or a 1.618 expansion, and then the market, cascades down. And usually the move will be, you'll take wave 4 times wave 5 and multiply it by 1.618, and that will give you what your ultimate price target will be on this particular target. So you have a tremendous amount of profit potential with a very little risk. And this is also something that we're looking at with the euro along with the stock market. This is the same pattern with the dollar versus the Japanese yen, and it's the same pattern only upside down. This is a buy pattern. You have the 135 on the downside, and you want to be looking to buy down near the 0.5. And if you'll see there on the left-hand side that red line on the bottom happens to be a 786 retracement of another swing. So these are the things that we're keeping an eye. I'm going to go through these quickly. I'm just trying to give you some some ideas of how these things look on a 5-minute chart. You'll see this happens to be a 30-minute chart. The other one was a 5-minute. It's the same type of pattern that you're looking at when you're going through this. This is a crude oil chart. This is showing the 135 patterns where you have higher bottoms. This is how you determine a trend. If you have higher bottoms, you're in an uptrend. The 135 pattern was made popular by a man named Roy Longstreet. He owned Clayton Brokerage during the 1960s out of Clayton, Missouri. He was the king of the soybeans. He and his son Bill were very avid traders. I knew Mr. Longstreet. He died, I believe, in 1996. He was about 93, and I knew his son Bill for quite a few years until he passed away. We were friends, and this was one of their favorite patterns. They didn't use the ratios until later. They used the ratios in the mid-'80s when Bill and I became friends, and he started looking at these fib ratios, but I put them in because I use them all the time. But basically, you're looking for higher bottoms. You have higher bottoms, you're in an uptrend. If you have lower tops, you're in a downtrend. So if you find one where you have 2 lower tops, you want to have a good place to short it, because all you have to do is put your stop over the second top, and you know exactly what your risk is, and your profit's going to be at least 1-to-1, so you have a 3-to-1 risk-reward ratio no matter what you're doing. So that's the importance of what we're watching here. Now this is a little bit of the cycle work that Jim Hurst did. It just shows that there's repetitive 48-week cycles that are here, and that's the the thing that you're looking at. I put all the patterns together to show you this what you're looking at. What's important here, folks, is that this, if you look down here at this August 2012 and the Japanese yen down here at around 76, go back and look at your charts and see where the big move in the dollar yen started, because that was the one that we really were screaming about to buy that down around that 77 level, and looking to see if that market was going to make that 135 pattern, which it did, and the low came in right at the 48-week cycle low. The problem with these cycle lows is they expand and contract. They'll stay for 3, maybe 4 cycles, and then it starts to expand and contract as the market moves away from the low point. And that's what's happened in the Japanese yen. It's moved, a lot different, because, we have already exceeded, we've actually gone to the 786 retracement of that 2009 high up to 103. So that's it stopped exactly at that level. So this is why we're watching the yen for a pullback, because this has potential to be a very long-term bull market. But we'll wait and see. We're almost finished here. This is a little bit about the transit stuff, what I did with astrology. This was the bottom of the stock market on March the 6th, 2009. It basically showed you that all these planets were right at the same level at 0 degree, getting ready to turn, and that was the bottom of the market. And this is how I do cycle research, because the planetary things are really quite accurate, and they give an idea of what's happening. Now I want to talk a little bit about the lunar cycle. We're almost finished here, so try not to fall asleep. This is very important, because you're going to be seeing this a lot in the future. I'm writing it, well, not just because of me, because of other things, but this work was done by a gentleman at Nomura Securities, Tom Pelk, who's a good friend of mine in London, and we had done some research on the new moons and full moons, and you want to be looking, if you buy on a full moon and sold on a new moon, you would have made about 63 times the amount of money that if you'd have buy and held since 1928. I mean, you go back and look at the numbers, but I have a new book coming out in 2014 that's going to go over the statistics on this and show you that the value here is absolutely amazing. But, you know, because it talks about the A word, astrology, people get afraid of it, but the problem is it's nothing more than a little bit of a numbers game. That's all it is. I mean, there's nothing mysterious about it. You know, the moon moves every 28 days. It's not a problem. This just shows you on S&P futures, if you sell on the new moon, you can see these spots through here. And there were 12 trades, 8 winners, 4 losers, and 2 of the losers that you had were on the exact lows of the full moon. And there's some other examples in here of buying on the new moon in bull markets. And even then, you're still going to be a winner because you had 8 winners out of 12 trades, and that's you know, the bottom line of what we're looking at. So what you want to do is on the strategy, you want to buy on the new moon and hold it for 5 trading days, and that's what you'd have done here. You're risking only 1% of your equity. You had 7 wins and 5 losses, and yet, you know, you still came out way ahead. So that's just showing you just simple probabilities of that are giving you really good ideas. And we've got some other things that we're putting in to show you that you can actually make it even better statistically. Because, you know, 7 out of 12 is still far better than a coin flip and far better than you'll get on any gambling event. But you can make it better by using a little common sense and some money management. I think we're almost at the end. Okay, this is what this is one of the things that I do. I watch the you know, the astro cycles things that are there, and the eclipse and the patterns, and that's just looking at the New York Stock Exchange Index, you know, on an hourly basis, looking at new moons and full moons and eclipse. That's all it really is. I don't want to get into the astro stuff. You don't need to do that. I just believe that, you know, I've always said that sometime before my final trade, I'm going to see a whole segment on CNBC and Bloomberg about the astroharmonics of the market. It won't come from somebody like me. It'll come from Princeton, MIT, or Oxford or Harvard, someplace like that, where academia has done the work. They've never put on a trade, but they, in fact, they know what the numbers are, and that's what the final thing is. I believe that's it, Mike. This is just some of the other things. That is it. So I will end the show here, and we will we'll have some questions, I think, right. And we will see what we can do.
Okay, guys. So before we move to give away the prizes, let's open it up for general Q&A. So go ahead and type some questions. Let me see what's on the board right now. Let's take a look.
Will the questions type up for me, Mike?
I'll ask them over audio for you. Let me just take a look.
Okay. I hope I didn't get too technical for everybody, but this is what I know and this is what I do. I don't know how to do it any other way.
Sure.
Because it's an esoteric subject, but it's quite easy to learn if people will take the time.
Let me ask a couple of questions of my own real quick. So for anybody that knows me, they know that I'm not a Fibonacci type of a guy. I have a question on when I look at people who post a lot of charts on the site. You know, a lot of these people are trading futures. In fact, most of them are trading futures. Most of them consider themselves scalpers. So most of them are trading small time frames, okay? And when I look at their charts, and you know, these guys, they make intelligent posts. I respect them, but I don't really agree with the methods. So that's why I wanted to ask you. When I look at the chart and I see all these different retracements, you know, not the ABCD stuff, but the 68.2, 78.6, you know, the other fib numbers.
Sure.
They seem to be like 20 lines on a chart that are separated by like 10 ticks, and it's like, you know, if you squint hard enough, you're going to see a pattern in any of it. So what's your answer for that?
Well, that's why I only use basically you know, 4 ratios on a chart that I'm looking at. That's really what I'm watching. What you can do is you can always find a number to trade off of. That's why Gann, you know, when you did the square of 9, you always had a number somewhere. So what I'm trying to do is I just look at 618 and 786 and try to match it with the pattern of that ABCD, and then I watch expansions of 1.27 and 1.618. That's really, what I'm looking at.
Okay, so you're looking.
I don't know. Can you still see my screen?
Yeah, we can.
Okay. Well, if you look here at the euro, the euro right here, you can see on this. This is just a 15-minute chart, but it's made this ABCD pattern right here perfectly. And you see it stopped right at the 1.27 of the BC swing. That's all I'm looking at. See, there's not any other ratios here at all. See, that's all I'm watching is that pattern ratio. But if you wanted to, you could put a lot of different things up there. But you don't really need to do that to be profitable.
Sure. And I am a big believer in confluence across multiple things in the market. So a 61.8 or whatever retracement to one guy might be a a VWAP line, a standard deviation, a weekly pivot,
sure.
Any
sure.
number of things,
Absolutely.
Right. So I guess
there's a lot of different ways to skin the cat in this business, as they say.
Right. So I guess my question at the end of the day is okay, at the beginning of your presentation, I think you said that 85% of it is mental. And I am a big believer in that. I think that people overemphasize the actual methodology. Like they take it too literal. They take it too mechanical. If this, then do that. Otherwise, do this. And it's not.
Absolutely.
It's not like that. So how?
Correct.
How can somebody that the Fibonacci stuff resonates with them? They want to use it. How can they decide what discretion to apply and when?
That's when you have to work on the most important cycle of all, and that's the 9-inch cycle, Mike. The cycle from your left ear to your right ear. You got to get inside your head. Fortunately for me, one of my best friends is Mark Douglas. He lives about an hour and a half from here in Scottsdale, Arizona, and Mark and I are good friends.
Right.
And I met him 30 years ago, and I was already doing pretty good, but after I met him, I started to get better. And when I mentor people, when I teach people how to do this, the main thing I try to do is, the chart part is real easy. It's getting inside the person's head to find out, what is he really thinking, why is he doing this and supposed to doing that. But it can be trained. You see, traders are not born, because there's too many people out there that are trading that are making a living at it, and they're not all born traders, believe me. I can tell you that right now. They can be trained to do this, but you have to realize that the technical part of it is around 20% max, and the 80% is the the mental part, and then also the money management of how much money they're risking. So you're absolutely right, Mike. It's an 80% mental game, or maybe even more, probably closer to 90, but I'm not sure of the figure.
Okay, so let's take a look at some other questions people have. So let me see here. Some of these are out of context because they were asked too long ago in the presentation, so you guys need to ask again. Let's see what we have. Futures operators asking for clarification on how you draw the 78.6 retracement from high to high.
Actually, it goes from, a 786 retracement cannot go from high to high. It has to go from a low to a high, and then you're retracing back, and so that would give you the retracement number that you're watching. If we could look at this euro example that I have here again, I'll just make it just a little bit larger here, and I'll just show you. See, this pattern has completed from this low to this high. You'll see it came in exactly at a 786 retracement right here, and now I completed the whole thing. Now here's where all your lines come in. You see, Mike, you look at this, you say, where in the heck did all this stuff come from? Well, it's stuff that happened in the past that, a person that's doing this like myself, I know where these numbers are, so these numbers are no longer significant to me. All I have to do now is to know that from the last high that we made up here, which was the ABCD, there's my 786 retracement coming in right here, just like this one did. You see, this one came down to the 786. This one comes down to the 786. Now the lines are gone, but the patterns are still there. See, I can look at this in a matter of a heartbeat and show you that that's a beautiful three drive pattern formed right there. Drive 1, drive 2, drive 3. There's your expansion level at 1.618. There's your expansion level at 1.27, and that's where you are. Your stop goes above 134.30. So you're risking 30 points, to make at least 90. So you got 3-to-1 in your favor. So I hope that helps.
Sure. Let me get to some other questions. Fawn's asking, because you mentioned the Astro part, he's asking if you're familiar with Delta Phenomenon published by Wells Wilder and
I sure am.
Steve Copen.
Yes, I know the Wells Wilder stuff. It's based on the 18-year nodal cycle. It's a total bunch of crap. It doesn't work, and anybody that tries to tell you that it does, don't walk away from them, run away from them. He had to move to New Zealand just to get away from the lawsuits that he was going to get.
Joe's asking if you still use neural networks in your trading.
Yes, I do.
Okay. Actually, that gives me a follow-up of my own. So how much of your trading would you say is automated versus mechanical versus pure discretion?
None of it is automated. We do everything by pure discretion, and as far as it's all pattern related. We don't do I won't do a simple retracement trade. I have to have multiple reasons. For instance, today, let me show you. This is the 30-year bond, and you can go back and just look at the 30-year bond over the last few days here. We'll just show you the patterns that are here. Just going back, I know this high was important, so I just put it on the chart. But that's the one that I was looking at, because you see you had a perfect retracement from that level, and then you had another one right at the 61, and then it came down today, and you had a perfect 61% retracement of the low and 786 retracement of the previous low. So we had three things to tell us that if we were to buy bonds at 139, we didn't have to risk very much, not more than 13 ticks, and our first profit objective was twice that, and it made the first profit objective already today. So your stop would go to break even on the Treasury bonds, for the remainder of your position, because you could get, we don't know what's going to happen, but nobody else does either. So we just wait to see what the next swing is going to bring us.
Okay.
But no, I don't do any automated trading, and I don't do any what I call seat of the pants type stuff. We basically just look at patterns. That's what we're doing. We look at Gartley's butterflies, ABCDs, 1, 3, 5 patterns, 3 drive to a top, and reverse point waves, and there's a few others in there, but that's basically it. Okay.
Javier is asking for some clarification on the ABCD patterns. He's asking how to determine the C point. Are you using like a measured move? What are you looking at?
Yes, you want to use a measured move. First, you always want to start your A point at the lowest part of the chart that you're looking at. And then you go up to see where the first, the B leg stops. You don't know where it's going to stop. But after the B leg stops and starts to move in the opposite direction, you want to start looking for it to come down to either the 61% retracement or the 786 retracement. That's what you're supposed to be doing. That would mark your C point. And then from there, the C leg forms when it comes out of C and goes up and makes the AB equals CD, target of what you're looking at. But the A point that you're looking at will always be the lowest starting point that you can find on the chart, the highest or lowest spot of that particular chart. Now, a 30-minute chart will be different than a 5-minute chart, of course, and the daily will be different than the others, but they all start the same way.
Okay. Tony is asking how long you should wait before confirming that a pattern has been established before you place your trade.
We don't wait any time at all. If point D is coming to our spot with our numbers, and as long as there's not a major report looming, like the Fed getting ready to talk or an employment report coming out at 8:30 in the morning on a Friday, we're going to be trading at that level because we don't believe in the fundamentals. We've already proved that to ourselves. So as long as we don't have a gap at that point where we have a tremendous amount of, volatility, we're going to be trading at that level because that's the level where we can control our risk the best. It's at that particular point. See, we're selling when everybody else is buying, and we're buying when everybody else is selling. That's a given. You got to buy them when you're crying and sell them when they're yelling. That's what they used to tell us on the floor.
Right. So let's talk about risk for just a second then. So would you consider yourself that you know the level ahead of time, so you're anticipating somewhat?
Yes.
Let's talk about risk. So when you're setting targets, and let's say that you determine that you want to use, I don't know, part of the leg for your target, do you use some mathematical number for your stop, like 50%, or how do you place stops?
No, we've determined that it actually comes down to a monetary number, Mike. It comes down between $300 and $500 on almost everything that we trade, with the exception of gold and crude oil, because gold and crude oil have a greater volatility, and their contract sizes are, in the $100,000 range. So you've got to move to about $800 to $1,000 on a trade in gold, and about $1,000, 80 cents, or $800 to $1,000 in crude oil. But everything else of all the Forex pairs are right at $500. 50 pips, is
Okay.
About the maximum. Now we might try that 50 pips 2 or 3 times before we get it right, but each time we control our risk, because we don't know which pattern is going to work. I wish we did know that, but we will never know that. So.
Sure. Okay. So let me ask another question. Speaking of not knowing what's going to work next, I find a lot of people do get caught up in that, and they have no confidence in their own methodology that they've developed themselves. Yep. Or even worse, if they're trying to copy or mimic someone else's methodology, then they really don't have confidence, right? So, if you've used things like Monte Carlo simulations or et cetera, then you probably know that you can have a long series of winners or losers. And you just mentioned yourself that you may have several 50 pip trades that don't work before one does. So, do you always use some type of a method that guarantees that your winner is going to be, twice as big or 3 times as big as your loser, or how do you set those up?
Yes, absolutely, because if you're trading the pattern, you put the odds better than 65% of being profitable. We know that by statistically looking at thousands of trades over a 40-some year history of actual trades, plus going back to 1885. I've looked at every swing, every 3% swing in the stock market, Dow Jones, I've looked at since 1885. And that's how I learned to do the astrology stuff, because I saw that the relationship between these things is far beyond a random event. I mean, they fit together like a glove and a hand. So I know that that's there. So that gave me the confidence that I know that we're going to be looking at probabilities on all the trades. So the next thing I had to do was determine to find a point where the profit potential would be at least 2 to 1 and preferably 3 to 1 of what I was going to risk. And that's how I came up with these patterns, the Gartleys, the butterflies, the ABCDs, and along with the ratios of these. That tells me what my risk factor is. It also tells me what my profit factor is, and also tells me what my probability factor is.
Right. Okay. And in all of these cases, I'm assuming that too many people seem to focus only on the actual win percentage, and they don't focus on the overall.
That's the definition of a loser.
Right.
That's the definition of a loser, Mike. A loser thinks how much money I can win.
Right, yeah.
You got to change that thinking. You got to think like the slot machine.
I agree completely. So I'm just trying to I ask questions and give everybody an opportunity to answer it, so people have more than just my opinion on the forum, right?
That's okay.
But a lot of people are asking or seem to be focused on that win rate over and over and over. So I just want to drill in again.
That's their problem. That's
right.
Not what
So you could be wrong half the time and still make an excellent living. You could be wrong 30%.
I know people. I know people that do that all the time.
Sure. Okay, let's talk one more thing about something you just said on the 50 pip room on most trades. So I'm assuming that most of your trades are based on daily charts?
Actually hourly, because the hourly will give you an idea what the daily's doing.
Okay.
But we look at hourly charts quite a bit because that focuses on the risk.
Okay.
Even closer than a daily, but we also look at the daily just to make sure we haven't missed anything. But the hourly is where we place our emphasis on analysis. Then we move down to either a 30-minute or a 15-minute spot for the actual entry of where we want to enter.
Okay. Now, I see a pattern over the last several years that I've run the site. There's a very distinct pattern that's formed, and that is that as people experience loss in trading, they tend to move to smaller and smaller time frame charts into where it's almost, I don't want to talk negatively about anybody, but I would use the word ridiculous that they're trading in such a small time frame that is full of noise. So let me ask you, do you think that any time frame works, even a really, really small time frame and like a 5-tick stop? Does that work, or is at some point?
No, well, it will work for some people that are able to do that, but frankly, I'm not able to do that type of trading because it takes too much energy, and I don't want to do that. And I'm interested in a small move, but the moves are there. The most actively traded thing in the world, of course, is the euro. Let me just bring it up here. Where is it? It must be under here somewhere. Yeah, here it is, right here. Let's just. I'm going to just give you an example right now. This is the 30-minute that we're, 15-minute, and it's really all I'm going to do now is I'm just going to move down to. Let's just go to a 5-minute. And let me get rid of all these ratios. These are things from, I haven't looked at this chart in a long time, so to get rid of it. This is a 5-minute chart, and we'll just look at these patterns, that we just talked about, and that's pretty much the same thing that we're doing. And this is really by far the most actively traded thing in the world. We've already talked about the bigger ABCD that was right here. That's the one that, this is why we were selling up in this area at 134. But if you go back and look at these others, I remember this is 5 minutes, but there's your A, B, C, D, and look where it takes you. It takes you right up into near that 134 level again. And there's others here too, but this is what people that trade on a short-term basis, that's what they're doing. They're looking at these smaller time frames, and there's nothing wrong with that. It's just that it takes a lot of energy, and it doesn't, doesn't really help. But look at the higher bottoms that you got here. Every time you could have bought a 786 retracement, I mean, it was perfect. Look, this is going back, the whole week. There's your 786. It goes 8 pips below it, and that could be because of Forex bank spread. This one here goes just a few pips below it. This one makes a 61%. You can see it right here. It shows 61% right there. And then the next one comes up and makes a 786, and it makes a 61% of the previous one. Look at this. There's the 61% of this low right here. And so, that's what you're looking at, and then it starts, making this last little move of where we are right now. So if it does, you can go down to a 1 minute. Let's just go to a 1 minute, and you'll see the same thing happen. I have to blow it up a little bit more, but you'll see the same patterns occurring on the 1 minute, just like we had before. Let me get enough data on here so I can see it, and you'll see. I don't want to spend a lot of time doing this because it's not the important thing. Well, it is, because it does show you that this stuff does work. But you'll see there's the 1 minute chart, and believe me, that's just, you can do the same thing on a 15-minute. There's another 1 minute A, B, C, D pattern here. Small, but you can't trade those. They'll drive you nuts. Like this one right here in the middle. Look, there's a nice pattern right here on the 1 minute chart, but you're going to sit there in front of the machine for, 30 minutes, wait for this thing to form right here to buy it, and to see that if it comes in, exactly at the 382 retracement right here. Are you going to do that? Well, if you're going to do that, then do it 1 minute. I don't want to do that. I'm looking at 14 things, Mike. I watched the major cross rates of the 6 big ones, Euro, Pound, Swiss, Canadian, Yen, and Australian dollar. Then I look at crude oil, gold, soybeans, wheat, corn, and then Treasury bonds, Treasury notes, the E-mini S&P 500, and the Dow Jones Industrial Average. I don't even do the NASDAQ. I have not traded the NASDAQ in years. We just don't do that one.
Let me change gears just a second. I've seen debates before on 78.6 versus 76.4. What's the deal with that?
Well, all I know is it hit 78.6 a lot more than it hit 76.4. That's all I can tell you.
Okay. So for some, I don't know what I guess at some point some popular platform started using 76.4.
I know where that comes from, and that's mainly because they didn't want to use 786. And you go back and look, just do the work yourself, defy human nature, and go back and prove to yourself that you'll see that 786 retracement almost all the time. Just pick the euro. The euro is the most actively traded thing in the world, and if you just pick that, you'll see that you're going to see that 786 retracement happen all the time, and not just part of the time. See, the problem with the 76 number is the 786, the reciprocal of that is 1.27, and that's what leads to that high. In other words, you come down to the 786, and then you expand up to the 1.27, completing the last part of the ABCD pattern that gives you the best, risk-reward trade that you can possibly get.
Right. I see some other people asking about 88.6 and
it's the same thing. Well, 88, you'll see that happen sometimes because the market will go beyond, the number, and that is a fib number, but you just don't see it that often, but it is there. That's why we put our stops right beyond the 90% level. We don't even wait to the old high. Our stops go in usually at around 92%. But the difference is if the difference between 786 and the 0.92 is too much, then we go to the dollar amount, which is $500. We don't do trades at 0.88. We don't do trades at 0.76. Our trades are done at 618 or 786 on contractions and 1.27 and 1.618 on expansions when we have the patterns together. And that keeps it real simple. You're only looking at 4 ratios. I never showed more than 4 ratios on this whole presentation.
Greg's asking the question about, he says that he started trading ABCDs, but he got beat up with multiple C-point pullbacks. He's asking if you have any rules that you use to make the best bet as to which one, when to take the trade for the C to D.
Well, he shouldn't take the losing trades. That's one of the things that I've learned right away. He should only take the winning trades. That's a joke, Chris, or
Greg. Yeah.
I was trying to be Glenn. But basically, you just have to look. If you're going to do C trades, look for that 1-3-5 patterns where you have higher bottoms. In other words, don't buy the first C pullback. Buy the second C pullback at the 618 or 786. That's the 1-3-5 pattern. That's a home run trade. That's got odds very heavily in your favor. You're trading in the direction of the trend. The odds of winning are better than 65%, and the profit to loss is 2 to 3 to 1. You can't beat that. And that's really simple. You don't have to have a computer to do that.
Mike is asking, he says a price chart is a square, so does that imply that we need squared charts to recognize geometric characteristics of a price chart?
If you don't have a squared chart, I don't know where you're getting your data because every chart I look at is square. I mean, they all got 90-degree angles. That's the whole thing. I mean, there's nothing else there. I mean, what are you going to use, a circular chart? I don't mean to be sarcastic, but no, everything is, it's just price and time, Mike. That's all it is. It's just price on the left axis, time on the bottom axis. That's the bottom line,
We've answered most of the questions. I'm looking for any that have not been answered yet. Franz asking, is it possible to trade the Gartley patterns in a programmed mechanical system?
Yes, there is. Well, I'm sure there is. There's I do a radio show, Mike, 3 days a week from 12 to 1 where I discuss the markets. It's www.TFNN, Tiger Financial News Network, that is run by Tom O'Brien. And they've come out with a new charting package called Art of the Charts that searches for Gartley patterns on a daily basis at the New York Stock Exchange using stocks and ETFs. And they usually come up with around 20 to 25 different Gartley patterns that they really do a good job of mathematically finding these patterns. But as far as doing it automatically, I've seen people try it, this present company included, spent several $100,000 on more than that, trying to program the Gartley correctly. The problem is that you have to find the right program. I was never able to do that, and so. But there are people that do it. I'm sure they are because I've seen them working on it. They just don't tell people what they're doing.
Okay, Chris is asking.
Unfortunately, I am a dinosaur when it comes to computers.
Sure. Chris is asking if you consider yourself to be a trend or counter-trend trader.
I'm a trader, Chris. I don't care what the trend is. You give me a pattern at the top, I'll sell it. You give me a pattern in the middle, I'll buy it. I don't care.
Javier and actually a few people are asking if you place any more importance on time charts versus other types of charts like volume or tick, range, Renko, etc.
No, don't look at. The only time I look at volume is when it's making historical records. Then I'll look at it. That's usually at a major top or bottom. Other than that, I don't watch volume at all during the day. I don't look at any oscillators. All the oscillators that I've ever seen whether it's stochastic relative strength, whatever they are, MACD, they're all lagging the market. And the reason why they work is because people understand risk control by using divergences or something like that, but the reason why they work is risk control, not because they're oscillators. They look really beautiful on the chart. They flat out, you know, they look great, but if they worked, you know, everybody'd use them, but the fact is they don't work. Some people can make them work, you know, but the oscillators by themselves, they don't work. They're lagging behind the market. Pattern recognition is what the market's doing right now. You might be wrong, but you're making an assumption of what the market's doing right now. That's the bottom line.
Okay, so I think that we've got most of the questions done. Before we move to the prizes, let me ask: do you have a website or an email address? Do you want to?
Yes,
people have any
if you want to. Yes, if you want to reach me, just go to LarryPesavento@gmail.com, and then I have a website which is www.tradingtutor.com. It's not an active website. It's just got a lot of great articles. There's a terrific article about Benoit Mandelbrot and fractals, and shows how these numbers, you know, work in nature. That's a tremendous YouTube video that's in there. That would be good. It shows a lot of the patterns that we look at. And I don't sell books on the website. I used to sell my books through the publisher Traders Press, but they went bankrupt because of Russell Walsendorf and you know, the fiasco that happened at PFG Best. So all of my books are published through Wiley now, and I have a new one coming out in 2014 on astrology, but that won't be out for 6 or 7 months probably.
Okay. All right. So
and the good part, my books are in five. My books are in 5 languages. You have Japanese, Chinese, English, German, and Italian. So the people all over the world have been using these patterns for a long time now, and so the books are published in different languages.
Okay. And you said it was tradingtutor.com, is that right?
Yeah, TradingTutor.com, Trading Tutor.
Okay. Just so you know, I've got a few people here telling me that Chrome is giving a malware warning, so you might want to have your admin take a look because they can't get to the site.
What?
Yeah, just have your.
I don't go to that site hardly ever. I'll check it out, but you say it's got a spam thing?
Malware. Chrome is blocking it. So yeah, just talk to your webman guy. He can probably do it.
Oh wow! Thanks for letting me know that. I had nothing. I don't understand that stuff, but I will definitely.
Okay,
I'll
man.
definitely do that as soon as we're done here.
Sure. So let's go to the the prizes. Now, I have 5 books that we're giving away, and you have 5 other things that you're giving away, so tell us what that is.
Okay, I will, for 5 people that don't win the book, I'm going to put them on a 1-month list of the charts and videos that I do each day in preparation for my trading. They'll not only be educational, there'll be some trades in there that will usually work pretty well. We just bought corn yesterday, and it moved well over $1,000, you know, the first 2 days, and that was one we've been waiting for well over 3 weeks. That's the type of thing that I will send out in the video. The videos last about 3 minutes. They'll have to understand a little bit about the methodology, but it's, you know, I'm really pretty much descriptive when I, you know, walk through the video because, you know, that's what I'm trying to do. Then I send out the charts each day of the things that I'm really focusing on. Like today it was the euro. Today it was the British, the Treasury bonds, and yesterday it was corn, and today and yesterday was gold too. We hit a major spot in gold possibly. That'll be one of the things that I'll focus on tonight, and you know, just whatever, you know, pops up on the trading screen, that's what I'm going to send out.
Okay. Okay. So
let me give 5 of those away for.
Sorry, there's a big audio delay there. All right, so I'm going to take back control and throw up my PowerPoint for the 10 questions. So 5 of them are the books written by Larry, Trade What You See, and those will be autographed, and then the other 5 will be Larry's service. So let me find the screen here. All right, everybody should be seeing the PowerPoint. All right, so a couple of real quick rules on the prizes. First, I'm going to ask for your BMT username if you're one of the winners. So have that handy, please. That's what I'm going to use to get a hold of you guys and get the contact info I need after the webinar is done. Second thing is it's one winner per webinar. Okay, one prize per webinar. So if you're holding out for a certain kind of prize, then keep that in mind. All right, let's get going. And these questions and prize answers were contributed by Larry. So let's see what we got. That audio delay is killing me. Okay, question one. Who is the father of modern geometry? All right, we've already got a winner. So Pythagoras and Chris, I need your BMT username. So congratulations. This is for the books. The first 5 questions are for the books. All right, Chris, waiting for the username. Okay. Go on to question 2. What is another name for the ABCD pattern? Okay, we've got the answer. Yeah.
Oh, if they don't answer, can I keep the book?
Yeah, we already got the answer. Trust me, these guys pay attention.
Okay, let's see.
Franz, so the answer is ABCD is also known as Thunderbolt.
That's correct.
So Franz, I need your BMT username, please. Okay. I think you've won prizes in another webinar, so good job. All right, let's go to number 3. Which is more important, risk or reward? Okay. And so the answer is risk, and because it's the only thing that you can control. And Manesh, C, I need your BMT username, please. So congratulations. Okay, let me get that. All right, number 4. What is the difference between gambling and trading? Okay, we've got the answer. Again, you guys are on top of things here. So futures operator, I need your BMT username, please. I think that is actually your username. So the answer is control. And trading, you control the rules of the game.
That's correct. You control everything in speculation. In gambling, you don't control anything.
Okay, so we're going to number 5. This is the last book. Let's see. Who is the author of the 1937 technical analysis book, Profits in the Stock Market? Okay, got the answer. So Gartley. And Wayne L. Need your BMT username. Okay, so for the following 5, it's going to be Larry's services for the prizes. Okay.
They'll enjoy that. That's a fun thing, and people like that. But when I don't send those charts out every day, I get emails asking me where I am.
Okay, let's see. Question 6. When trading Forex, what does a pip mean? So the definition
I want to see who gets this. No,
not looking. Yeah, not as. Yeah, there we go. Okay. Well, actually, I misspoke. Close, but not quite.
That's the toughest question that I came up with.
So
someone came very, very close. If we don't have a winner, I will know. There it was. Yeah. Somebody had it.
All right. Well, you already won, though. Sorry, man. One prize per. Oh, there we go. John. Okay, so John H., I need your BMT username. So the answer is it's a percentage in price.
Yeah.
So.
Ben Stein, the famous columnist, I was on a panel with him once, and boy, that guy is really smart. He's the son of Herb Stein, the former winner of the Nobel Prize, and he, not Nobel Prize, what was it? What's the one in publishing? Oh, anyway, he's a really savant, and he's a really nice guy, too. but he was the one that answered that question. I didn't even know, and I'd been trading Forex for years. I didn't know what PIP meant, and that goes back about 10 years ago. But
all right, so let's see. Questions.
Pulitzer, that's what it was. It was a Pulitzer Prize. Thank you very much. Yeah.
Question 7 is, what city is the hub for Forex trading?
Boy, you guys are quick. You got people awake in there. That's good.
Yeah. All right, Melissa S., I need your BMT username. So the answer is London. And, okay, Melissa, that looks familiar to me. I think that you also won a prize in another webinar. So good job, guys. All right, so let's see, number 8. What are the first 4 numbers of the Fibonacci summation series? Okay, we got some guys that are paying attention.
Well, we are. I like it. I like it. When I first started giving these lectures 30 years ago on Fibonacci, man, it was tough because people had no idea what they meant or who he was or anything like that. But this is great now that we're seeing it. So
Lawrence C., I need your username. So the answer is 1, 1, 2, 3.
That's good, because 0 is not a number.
Okay, got that. So number 9 here. What is the most actively traded instrument in the world?
Man, what do these guys must have their hands on the typewriters?
I know.
Mike, if any of the folks, I don't know if, I do a newsletter for the hedge fund, and if you want to send it out to your folks or make it available, I could do that. If you'd like to, I could send you a copy of it if the folks would like to see it. It gives you an idea what I'm looking at in the different markets.
Sure, I can follow up with you on that. So
yeah.
Justin H., I need your username, please, and the answer is the euro. So good job, guys. One more after this. As soon as I get Justin's, there we go. Okay. All right, number 10. What is the significance of 1913? What happened?
Wow. How did somebody do that, man? That's really good. That's very good. Okay, what's the name of the book? The Creature from Jekyll Island.
So,
yeah.
So Gary I need your BMT username, and the answer is the Fed Reserve. All right, so congratulations, guys.
Yeah, that's very good. That last one, that PIP one and the last one were the 2 toughest.
All right, so congrats to the 10 winners. I'm going to reach out to you on BMT as soon as the webinar is done and get the autograph requests for Larry for the 5 book winners, and then I'll get your contact info for the newsletter that Larry will send you for the 5 other winners. And guys, the recording of this will be made available sometime tomorrow. And also you can find Larry's book on Amazon if you weren't one of the winners and you want to check it out. And Larry, I think you said you got one more book coming out next year?
Yeah, that'll be Introduction to Financial Astrology. It's a rewrite of my book from 1987, but because of computers now, we're able to do a lot more statistical studies quicker, and it could statistically prove that things work better than we could back then.
Right. Okay, so Larry, thank you very much for your time and putting together the presentation and for answering everybody's questions today. I really appreciate it.
Okay, thank you.
Thanks, guys.
Bye-bye.
Bye.